Let me ask you something really quick. You worked hard your whole life. You paid your taxes every single year without fail. You finally retired, and now the IRS sends you a penalty notice, not because you underpaid, not because you cheated, but because of when you paid. If that sounds impossible, I promise you it's not only possible, it's happening to thousands of retirees right now. And if you retired last year or the year before, it could be about to happen to you. Stay with me, because in the next few minutes, I'm going to walk you through exactly what this trap is, how the IRS calculates it, and most importantly, 3 specific strategies that can eliminate the penalty completely. And when I say eliminate, I mean bring it all the way down to 0, legally, using rules the IRS itself put in place, rules that almost nobody tells retirees about. My name is your guide here at Retiree's Guide, and if this is your first time here, welcome. We talk about the real stuff that affects your money in retirement, not the glossy brochure version, but the actual details that can cost you or save you real dollars. If you want more of this, go ahead and hit that subscribe button right now. We put out new content every week, and this is exactly the kind of thing we cover. Now let's get into it, because this is genuinely important. Here's where the whole problem starts. When you were working, your employer withheld taxes from every single paycheck you received throughout the year. Every 2 weeks, that money went straight to the IRS before it ever hit your bank account. You didn't have to think about it. You didn't have to schedule anything. It just happened automatically. You filed your return in April. You maybe got a small refund or owed a small amount, and you moved on. That system worked perfectly because your employer was handling the timing for you. The moment you retire, that system stops completely. And here's the part that trips people up. The IRS doesn't care that you stopped receiving a paycheck. The IRS still expects taxes to be paid throughout the year on a regular schedule as your income comes in. They call this the pay-as-you-go system, and it is baked directly into the tax code. There's no grace period for new retirees. There is no transition phase. The expectation is the same on day 1 of your retirement as it was when you were working. Now, you might be thinking, well, I'm still getting income. I have my pension, I have Social Security. Maybe I'm taking withdrawals from my IRA or my 401k. Surely those come with withholding built in, right? And this is where most retirees get blindsided because the answer is not automatically. Unlike your old paycheck, withholding from pension payments, Social Security, and retirement account distributions is almost always voluntary. You have to specifically set it up. If nobody told you to do that when you retired, and many financial institutions don't make it obvious, then your income has been flowing in all year with 0 taxes withheld. And the IRS has been watching that clock tick every single quarter. The IRS divides the tax year into 4 payment periods. The deadlines fall on April 15th, June 15th, September 15th, and then January 15th of the following year. The IRS expects you to be paying your tax bill in installments across those 4 dates. And here's the cruel part, and I really want you to hear this clearly. If you pay nothing during those quarters and then sit down in April and write one big check for everything you owe, the IRS does not see that as being on time. They see 3 or 4 separate late payments. And for each of those quarters where you were short, there's a penalty running against you independently under Internal Revenue Code, Section 6654. That penalty currently runs at 7% annually, compounded daily, so it's not one flat charge. It is compounding interest, ticking away on each quarter separately, adding up by the time you file. People are genuinely shocked when they see the number on the notice, because they thought they were all squared up when they mailed that check in April. And here's the thing that really gets under people's skin. You can owe $0 in total tax at the end of the year, meaning the IRS confirms you paid everything and still receive a penalty notice. Because the penalty isn't about the final amount. It's entirely about the timing. That is why I call it a timing trap. The IRS is not penalizing you for paying the wrong amount. They are penalizing you for paying at the wrong time. 2 completely different things. And most retirees don't realize that until the notice arrives. So how does this typically play out in real life? Let's say you retired in early 2024. Your income that year includes pension payments, you start collecting Social Security, and maybe in December you take a required minimum distribution from your traditional IRA. You never set up withholding on any of it because nobody walked you through that step. Come April 2025, you sit down with a tax professional, you add everything up, you write a check for the full amount, and you think you're done. A few weeks later, a notice shows up. The penalty notice is for an amount that could range from a couple $100s to over $1,000, depending on how much you owed and how far off you were each quarter. You paid your taxes, every dollar, but you paid them all at once. And the IRS considers that 4 quarters of underpayment followed by 1 large correction. That's how the math works. Now here is where I want to stop and take a breath, because I don't want this to feel hopeless. There is genuinely good news here, and it comes in the form of 3 specific protections that the IRS has built into the tax code. These are real rules, they are documented, and any one of them can protect you completely. The first one is called the safe harbor rule, and it is the most commonly used protection. There are actually a few ways to qualify. The simplest version says that if you pay at least 100% of what you owed in taxes the prior year, split across those 4 quarterly dates, then you cannot be penalized, even if your current year's tax bill ends up being higher. So, if your 2023 tax return showed you owed, say, $10,000 in federal tax, and you made quarterly payments in 2024 that totaled at least $10,000 spread across the year, you are protected, period. Now, if your adjusted gross income was over $150,000 on that prior year return, the threshold bumps up to 110% instead of 100%. But the logic is the same. You're essentially saying to the IRS, I used last year's number as my guide and I paid it faithfully through the year. And the IRS says, fair enough, no penalty. There is also a version of the safe harbor based on the current year. If you pay at least 90% of what you actually owe for the current tax year through your quarterly payments and withholding, that also shields you from the penalty. The challenge with this version is that it requires you to accurately predict your tax bill before the year is over, which can be tricky in your first year of retirement when your income is changing. That's why most retirees find it easier and more predictable to use the prior year approach. And there is one more threshold worth knowing. If your total balance due, after accounting for all withholding and credits, is under $1,000, no underpayment penalty applies at all. So if your retirement income is modest and you come in under that mark, you're already in the clear without having to do anything special. The second strategy is something I call the December withholding move, and it is one of the most powerful tools a retiree has available. Here's why it matters. When money is withheld from your income, whether from a pension, an IRA distribution, or even your Social Security if you've set that up, the IRS treats that withholding as if it was paid evenly throughout the entire year, regardless of when it actually happened. So if you get to October or November and you realize you haven't been making quarterly payments and you're worried about a penalty, you can contact your IRA custodian or pension administrator and ask them to withhold a large amount from a December payment. That withholding gets credited as if you had been paying all year, 1 quarter at a time. It essentially lets you retroactively solve an underpayment problem right at the finish line. This strategy is particularly useful for retirees who take their required minimum distributions in December anyway. Instead of taking that RMD with 0 withholding, you tell your custodian to withhold a meaningful percentage, maybe 20 or 30% or whatever covers your estimated tax obligation, and just like that, the timing problem disappears. The third protection is one that almost nobody knows about, and it is specifically designed for people in your situation. The IRS has a formal waiver provision that applies if you retired last year or the year before. Specifically, if you retired after reaching age 62 in either the current tax year or the preceding tax year, and you had a reasonable cause for not making your estimated payments on time, the IRS is required by the tax code to waive the underpayment penalty entirely. This is filed using Form 2210, and you mark the box that applies to this specific situation. The key phrase is reasonable cause, and simply not knowing about the estimated tax requirement after a lifetime of employer withholding is widely recognized as a legitimate basis. You're not trying to hide anything. You're not claiming hardship. You're simply saying, I just retired, I came from a system where my employer handled this, and I didn't know I had to set up my own payment schedule immediately. The IRS built this waiver specifically to protect people in that transition period, and it covers the first 2 years after you retire. Let that sink in for a moment. There's a specific IRS waiver for people who retired in the last 2 years. It covers the penalty completely. And the IRS will absolutely not mention it on the penalty notice they send you. They will simply send the notice, list the amount owed, and give you instructions for paying. The waiver exists in the instructions for Form 2210. And if you don't know to look for it, you won't find it. This is why I made this video. Now let me talk about required minimum distributions for a moment, because this is a major piece that catches a lot of retirees off guard. Once you reach age 73, you are required to take minimum withdrawals from your traditional IRA, your SEP IRA, or your 401k each year. These distributions are fully taxable, and by default, most custodians do not automatically withhold any federal tax from them unless you specifically request it. A lot of people take their RMD and treat it like a regular account withdrawal. They use it to cover living expenses and then get surprised at tax time when there's a large tax liability that wasn't accounted for. And because the RMD often comes out in a single lump at the end of the year rather than spread across 4 quarters, it can make the quarterly payment problem even worse if no withholding was set up. The solution, as I mentioned, is to request withholding directly on those distributions, so the tax is captured automatically as the money comes out. The same logic applies to your pension and to Social Security. If you receive Social Security benefits, you can file a Form W-4V to have federal income tax withheld at a rate of 7, 10, 12, or 22%. It's voluntary, but once you set it up, it works just like paycheck withholding, steady, consistent, and credited evenly through the year. For your pension, you can submit a W-4P to your plan administrator with whatever withholding instruction you want. These are simple forms. They take maybe 10 minutes to complete, and they solve the entire timing problem going forward. Here's what I want you to take away from all of this. The IRS built this system around the assumption that you have an employer doing the tax timing work for you. The moment you retire, that assumption becomes false, and nobody hands you a memo about it. The penalty under Code 6654 is real, the compounding is real, and the notices arrive without any explanation of the escape routes available to you. But those escape routes are just as real. The safe harbor rules, the December withholding strategy, and the retirement waiver on Form 2210 are all legitimate legal protections that were put in place specifically to keep situations like yours from turning into an unexpected tax bill. If you retired last year or this year, here's what I would suggest you do this week. First, check whether you have any tax withholding set up on your pension, your Social Security, or your IRA distributions. If the answer is no, contact those institutions and get it done. Second, if you're coming up on a required minimum distribution and you haven't been making quarterly payments, talk to your custodian about withholding a percentage that covers your estimated tax. Third, if you've already received a penalty notice for last year, don't just pay it. Look at Form 2210 and check whether you qualify for the retirement waiver. If you retired after age 62 in 2023 or 2024, there's a very good chance you do. And fourth, and I know this feels obvious, but it matters in a tax professional who works with retirees regularly. This particular area of the tax code has a lot of moving parts, and having someone in your corner who knows these rules can save you real money. I want to ask you something before you leave. Have you received a penalty notice that you weren't expecting, or are you worried you might be in this situation right now? Drop a comment below and let me know. Tell me where you are in the process, whether you just retired, whether you've already gotten a notice, or whether you're trying to get ahead of this before it happens. I read the comments, and I want to know what's actually going on in your world so we can keep making content that actually helps you. If you found this video useful, and I really hope you did, please share it with someone you know who retired recently. A lot of people are going to be getting penalty notices in the coming weeks who have no idea this waiver even exists. And sharing this video could genuinely save them hundreds or even thousands of dollars. If you haven't subscribed yet, now is a great time. Hit that subscribe button, ring the notification bell, and you'll catch every video we put out. We cover Social Security timing, Medicare decisions, retirement account strategy, and exactly this kind of tax issue that nobody else is talking about in plain English. Thank you for spending this time with me today. I'll see you in the next one.